So in the last class, we started our discussion on adjusted present value. Adjusted present value, which is also part of capital investment decision, because sometimes you might want to make investments that will require you to diversify from your existing business into another. And when that is into play, it shows that you need to apply the concept of adjusted present value, where you need to compute your base case NPV, determine your financing effects, such as the issue of subsidy, the issue of your tax relief, and so on and so forth. So this morning, we're going to solve an ACCA question that's involve all these variables that we've learned over time. And after this question, I'm going to also forward an ICANN question for us to solve as an assignment to see the level of our understanding on this concept. So this question is an ACCA question, but I know ICANN has also adopted it one way or the other. So we're going to solve this question in a very fast way this morning. So this question is a cross-fertilization of ideas from what we've learned on NPV, the normal NPV that involve inflation, that involve capital allowance, and so on and so forth. So when we start solving, you'll see, even when you read, if you've studied this question, you'd have seen those elements in this question. So can somebody read, please? Yes, somebody should read.
You have recently commenced working for Equatorial PLC and are reviewing a 4-year project which the company is considering for investment. The project is in a business activity which is very different from Equatorial's current line of business. The following net present value estimate has been made for the project. All figures are in million. Net present value is negative 1.65 million, and therefore the recommendation is that the project should not be accepted. In calculating the NPV of the project, the following notes were made. 1. Since the real cost of capital is used to discount cash flows, neither the sales revenue nor the direct project costs have been inflated. It is estimated that the inflation rate applicable to sales revenue is 8% per year, and to the direct project cost is 4% per year. The project number 2, the project will require an initial investment of 38 million. Of this, 60 million relates to plants and machinery, which is expected to be sold for 4 million when the project ceases, after taking any taxation and deflation impact into account. Note 3. Tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year thereafter on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. Equatorial pays 20% tax on its annual taxable profits. No tax allowable depreciation is available on the remaining investment assets, and they will have a net value at the end of the project. Note 4. Equatorial uses either a nominal cost of capital of 11% or a cost of capital of 7% to discount all projects, given that the rate of inflation has been stable at 4% for a number of years. Note 5. Interest is based on Equatorial's normal borrowing rate of 150 basis points over the 10-year government yield rate. Note 6. At the beginning of each year, Equatorial will need to provide working capital of 20% of the anticipated sales revenue for the year. Any remaining working capital will be released at the end of the project. Note 7. Working capital and depreciation have not been taken into account in the net present value calculation above. Since depreciation is not a cash flow and all the working capital is returned at the end of the project, it is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government, which lends money at a rate of 100 basis points below the 10-year government debt yield rate of 2.5%. Issue costs related to raising the finance are 2% of the gross finance required. The remaining 40% will be funded from Equatorial's normal borrowing sources. It can be assumed that the debt capacity available to Equatorial is equal to the actual amount of debt finance raised for the project. Equatorial has identified a company, Ethiopia, which operates in the same line of business as that of the project it is considering. Ethiopia is financed by 40 million shares trading at 3 naira 20 kobo each and 34 million debts trading at 94 naira per 100 naira. Ethiopia's equity beta is estimated at 1.5. The current yield on government treasury bills is 2%, and it is estimated that the market risk premium is 8%. Ethiopia pays tax at an annual rate of 20%. Both Equatorial and Ethiopia pay tax in the same year as when profits are earned. You are required to A. Calculate the adjusted present value for the project, correcting any errors made in the net present value estimate above, and conclude whether the project should be accepted or not. Show all relevant calculations. B. Comment on the correction made to the original net present value estimate and explain the adjusted present value approach taken in part A, including any assumptions made.
All right, thank you very much for that. So
You're
this
welcome.
is the question, an interesting question that can see very lengthy, unlike what we used to have in PM and FM. Yes, so to solve this question, we need to borrow knowledge from different points that we've learned over time. But before we go ahead, there is need for us to know what basis point is, in which I put on the platform yesterday that we should do a research on what basis point is. That basis point is a unit in finance that is used to measure small changes in interest rates, bond yields, lending rates, and other financial percentage. When you say 1 basis point, 1 basis point simply means what? 1%. Another word for basis point can be termed as spread. Spread. That is, spread is the rate above or below normal borrowing rates. So we can have a normal borrowing rate. What is the increase over the normal borrowing rate? So when we talk about basis points, it's a way of expressing increase in a percentage. Instead of saying the interest rate have increased by 1%, by 2%, some can confuse that percentage to mean different things. So financial experts, as a way to make it definite that this is what they are pointing at, they use basis points. They use basis point. If you are used to business news, you see most of these business newscasters using the word basis point, even as they talk about business issues daily. So 1 basis point means what? means 0.01%. That is 0.01%. That is 1/100 of 1%. So when you talk about 1 basis point means increase in what? It's not 1% now, but 0.01 increase or decrease. When you talk about 100 basis points, 100 basis points means what? Means 1%. Means 1%. That is 100 basis points. When you talk about 50 basis points, 50 basis points will now means what?
0.50%.
Yeah,
0.505.
yeah, 0.50%. And when you have 25 basis points, it means what? 25 basis points,
0.25%.
0.25%. When you have 500 basis points, what is the meaning?
That is
That's
5%.
about,
Zero
no.
point
Five
five.
percent.
Yes, 5%. Yes, 5%.
5%.
That is 5%.
5%. Yes,
Yes,
5%.
5%.
Yes, 5%. That is 500 basis points. That is 5% increase or 5% decrease, depending on what the question is referring to. So instead of using the normal layman language, as financial experts, you can use basis points to communicate. So the fact that you're a professional student, the examiner will not use the normal increase by 5%. They can use basis points. And once you see basis points, it's not something you should run away from. They are normal terms that we should be familiar with. And that is why we need to analyze that. When you see 100 basis points, it means 1%. When you see 200 basis points, it means 2%. When you see 50 basis points, it means what? 0.50%. And when we have 10 basis points, it means what? 0.10%. So that is the interpretation of basis points. So if you look at the question, you'll have seen at different points, you're mentioning basis points. They mention basis points in the course of the computation or in the course of the question. So let's take note of this. So when you see, you keep seeing it as we talk about different topics. Yes, you'll be hearing basis points, 100 basis points, it's 1% increase or decrease, 50 basis points in that order. So the basis point is percentage change, and that is how it works. So now, going back to the question, we already have computed net present value figures, but they are now telling us that there are certain errors in this computation. That can we recompute ours? Now, going through the question, you will discover that we need to do some adjustment. For example, when you look at your sales revenue, there's a statement about sales revenue, about sales, that since the real cost of capital is used to discount cash flows, neither the sales revenue nor the direct project cost have been what? Inflated. It means they've not been inflated. So it is estimated that the inflation rate applicable to sales revenue is what? 8% per year, and to direct project cost is what? 4% per year. What will be the adjustment in this case? What will be the adjustment? Any idea? The adjustment,
We have to adjust for inflation, which is
yes,
each each figure recognized for year one to year four has not been reflected inflation rate. So we have to multiply the number by 1 plus inflation rate.
All right, fine. Yes, so we need to recognize the years too. Like the inflation rate for cells is 8%. So it will be what? It will be 1.08 to the power of 1 for year 1, multiplied by what? 23.03 for year 2. To be 1.08 to the power of what? 2, multiplied by what? 36.60 for year 3. It will be 1.08 to the power of 3, multiplied by what? 49.07. And for year 4, to be 1.08 to the power of 4, multiplied by what? 27.14. That will be the adjustment for us to get the inflated sales revenue. And for the direct project cost also, we also have a statement that what? The direct project cost is 4% per year. That is inflation rate applicable. We also need to adjust for that. Without any delay, let's solve. Instead of me doing the explanation one after the other, let's just quickly solve. Solution. So we'll now see how far we can go. Solution. We'll pick each of the information one after the other. Solution. To adjust for sales revenue. Just say this is workings. Workings. We have the sales revenue. The sales revenue. For us to effect the inflation, to make it easy, just come up with a table to make it easy and your work needs. We have year, we have year 1, year 2, year 3, year 4. The figures are all in million. Figures are in million. So we have it, the sales revenue for the first year is what? 23.3. Second, 36.6. The third, 49.07. And the fourth is what? 27.14. The inflation rate is what? Inflation rate. We have it as what? 1.08 to the power of 1. You have it as what? 1.08 to the power of 1. This will come as 1.08 to the power of 2. And this will be what? 1.08 to the power of 3. And we have this 1.08 to the power of what? Of 4. So when you punch your calculator, your inflated sales revenue will be what? Inflated sales revenue.
Year 1 is 24.87.
24.87. And year 2.
42.69.
42.69. And year 3.
42.87. 61.81.
Yes, and for year 4,
36.92.
36.92. So this is for the sales revenue. Work 2, I have the direct project costs. Direct project costs. For direct project costs, the inflation rate is what?
4%.
4%. So you do same. You have it the year 1, year 2, year 3, and we have year 4. Figures are all in million. Your direct project costs, as given in the question, direct project costs for year 1 is what?
13.82.
13.82.
21.96.
13.82, 21.96,
29.44.
29.44, and
16.3.
16. Your inflation rate.
4%.
Inflation rate at 4%. This will give us what? 1.04 to the power of 1. The power of 1. Your inflated costs will now be what?
For year 1, we have 14.37.
14.37. For year 2,
23.75.
23.75. And for year 3,
33.12.
23.12. And for year 4,
19.05.
19.05. So this is based on the additional information. The next I would like us to look at, let's see the issue of working capital. That the project will require an initial investment of 38 million. Of this, 16 million relate to plant and machinery, which is expected to be sold. We are coming back to this. Okay, now in relation to this, let's talk about this. This is telling us that there will be need for us to compute our capital allowance. There will be need to compute what? Capital allowance. That tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year thereafter on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. That Equatorial pays 20% tax on its annual taxable profit. No tax allowable depreciation is available on the remaining investment assets, and they will have a nil value at the end of the project. So now, based on this information, the value of plants and machinery is what? The value of plants and machinery is
16 million.
16 million. Now, the question made it clear that the first year, the annual allowance will be what?
50%,
50%. And subsequently, it will be what?
25%.
So based on this, we need to get our tax saved. The essence of capital allowance is to determine our tax saved. If you watch the video I referred us to, you would have seen where we solved this. We solved something like this while we're talking about investment appraisal in relation to inflation, capital allowance, and so on and so forth. So let me say work 3. Tax saved on capital allowance. You know, another word for capital allowance in the normal accounting palace is what? Depreciation. So tax saved on capital allowance. Now, for you to determine your tax saved on capital allowance, you need a table. Not necessarily a table, but I just want to present mine in a table to make it clear. So we have here, can have details or narration, whichever, can have the costs, and we can have tax saved. Tax saved can be derived using what? How do you derive your tax saved? Tax saved on capital allowance. How do you derive it?
You apply the tax rate on the capital allowance.
Very good. Now, what is our tax rate in the question?
20%.
20%. 20%. See it. Equatorial pays 20% tax on its annual taxable what? Profit. So 20% is the tax rate. So now, in here, as at the beginning, when the asset was procured, the cost is what? The cost 16 million. 16 million. 16 million. $16 million. Now, as at the end of the first year, your annual allowance will be what? At 50%. Annual
8,000. 8 million.
at 50%, 8 million. So we have it 8. The difference between 16 and 8 will be what?
8.
That is the tax written down value. And that will give you what? 8. Your tax saved on capital allowance will be what?
1.6.
1.6.
1.6. So at this point, you have what? 1.6. How do you get 1.6? 0.20 multiplied by what? 8. You have 1.6. Year 2. Your annual allowance will be at what rate? Annual
25.
allowance at 25%. It is stated in the question that the first year will be 50%. Subsequent year will be what? 25%. So based on that, 25% of 8 will give you what?
2.
2. Give us 2. So now your tax saved on capital allowance will be what?
0.4.
0.4. Coming to the difference between 8 and 2 will give you what?
6.
And this 6 is your what? Your tax written down value. your tax written down value. So as at year 3, what will be your annual allowance?
25%.
Annual allowance at 25%. 25% of 6 will give you what?
1.5.
1.5. Tax savings will be what? 0.2 multiplied by what?
1.5.
1.5. And this will give you what?
0.3.
0.3. Give us 0.3. Now the difference will now give us what here? The tax written down value.
4.5.
We have it as 4.5. As at the 4th year, which is the terminal point, we need to ask ourselves, what is the sales proceed, the scrap value?
4
As at
million.
4 million. Now, where your sales proceed is less than your tax written down value, what will you have?
Balancing allowance.
Balancing allowance. Will the balancing allowance enjoy tax savings? With the balancing, yes, with the balancing allowance enjoying tax savings?
Yes.
It is yes. We explained this very well in one of the classes, and in the video you will see that explanation again. So it will enjoy tax savings, but where it is balancing charge, it means your sales proceed is greater than what? Your tax written down value. You are the one to pay the tax authority because you have more profits. So now, in this case now, the difference between your tax written down value and your sales proceed will give you what?
0.5.
Give us 0.5, and this 0.5 will be termed as what?
Balancing allowance.
Balancing allowance. Balancing allowance. So the tax saved on this balancing allowance will be what? Multiplied by what? 0.5. This will give us what?
0.1.
0.1.
0.1. So this is your workings as it relates to the tax saved on capital allowance. So now we have a story about working capital. We have a story about the working capital. Point 6, that at the beginning of each year, Equatorial will need to provide working capital of what? 20% of the anticipated sales revenue for the year. Any remaining working capital will be released at the end of what? Of the project. Now, your working capital will now be what?
20% of this.
Yes, 20% of sales anticipated for each year. This is what? 3. We have 4. Working capital. Working capital. So we have it as this. Same, we have the year. You know, working capital will commence at which year?
Year 0.
Year 0. We have 1, 2, 3, and 4. But now, you know the sales. The sales revenue for year 1 is what?
14.37.
Okay, the sales revenue for year 1
14.3. Okay, sorry.
will be 24.87 from this computation here.
Yeah.
24.87. Let me just copy this. 24.87, 61 in that order. So we have it. Now, the question is saying that what? 20%. The working capital at 20% will be what? 20% of year 1 sales will give you what?
4.974.
4.974. Okay, let's work with 2 decimal places. For year 2, it will be what? 20% of 42.69 will give us what?
8.54.
8.54. And for year 3, 20% of 61.81.
12.36.
12.36. And for year 4, 20% of 36.92.
7.34.
7.34.
Sorry,
No.
7.38. 7.38.
7.38. Now, as at the beginning of the year 0, working capital, the value will be what?
Year 0
Right,
is
increment.
negative 4.97.
Yes, negative 4.97, because it's an outflow. Is money of your business. So incremental working capital. So now we have a negative of what? 4.97. Now, as at the beginning of year 1, what value will you need? You know, in year 2, which will be in year 1, you need 8.54. Is it this whole value? Will you recognize this whole value in year 1? What will be the value to be recognized?
3.57.
3.57. Do you all agree with that? Let me come back to the class. Madam Chidima.
Yes.
What? Okay, you said yes. That is Madam Nkechi. Madam Chidima, are you there?
Explain it though. I'm here. Oh.
No. No, I'm not supposed to explain this to you again. This is working capital, incremental working capital. You already have 4.97. As at the end of year 1, this whole money is available. In year 2, you need 8.54. Will you recognize the whole of 8.54? It is no. It is the
No,
increment.
the difference.
The difference that you recognize. The difference that you recognize. Madam Pride. Is not there. I'm in favor.
Present, sir. Good morning, sir.
Good morning, ma'am.
Yeah. Yes, sir.
Right. Madam Victoria.
Yeah, we can go ahead. I'm having running stomach. I was not following up with this one.
Okay, sorry. Mr. Friday, hope you are there.
I'm with you, sir.
All right. So now, it will be the incremental value that you recognize. That is 8.54 minus 4.97. That will be what you recognize, because this is working capital, is a revolving cash, as I usually say. It's moving. You understand? So you won't just go and recognize the whole value again. It will be the incremental effect, and the value will be what? And also in year 2, the value to be recognized will be what? 12.36 minus what? 12.36 minus what? 8.54. And what will be the value?
3.82.
3.8. 3.82. In year 3, how much will you recognize?
Positive 4.98.
Yes, positive 4.98, because now you need a lesser value. You already have how much invested? 12.36. Now you need a lesser value. It means you're going to have a positive value here. That is, you need 7.38, but you already have in existence what? You already have 12.36, but you need what? 7.38. The difference is what? The difference is what?
4.98.
4.98. So that 4.98 is the balance you have. How much do you still have outside?
7.38.
7.38. That is this whole value here. 12.36 minus this, which is this 7.38. As at the end of the business life, what will happen to it? You have to recoup it back. It will be returned back to the business, because the business is coming to an end as at the end of the 4th year. So this 7.38 will now be recognized. If you check the solution, one of the questions we treated, you see this playing out also. One of the questions we treated together some weeks ago, you see this playing out. So that is how to treat your working capital. That is how to treat our working capital. Hope this is clear.
Yes,
So
sir.
the next point we are to look at is let's look at the issue of, okay, I think with this we can come up with our base case NPV. We can come up with our base case NPV. That is, we can draw up another table to prepare a new NPV with this. So let's see if that will be possible.
Hello,
So-
Mr. Tokwe.
Yes, sir.
Are we going to agree with them with the discount rate that they use?
The discount rates.
Yes,
The discount rates.
they use
What discount rate did they use?
7%.
Okay, the discount rates, they use 7%. Okay, no, we're not going to agree with that. So we're going to still show a working. We're going to still show a working. We are not agreeing with that. And that is why we need to do our working. Our base case NPV. How do we determine base case NPV? You know, we showed a step in the last class. Now, because they are trying to deviate. They are trying to deviate now. So going to the question that the remaining 40% will be funded by Equatorial. Okay, now Equatorial has identified a company, that is Ethiopia, which operates in the same line of business as that of the project it is considering. So Ethiopia is financed by what? 40 million shares, trading at what? 3 naira 20 kobo each, and 34 million debt trading at what? 94 naira per 100 naira. Ethiopia's equity beta is what? Estimated at what? 1.5. The current yield on government treasury bill is what? Is 2%. And it is estimated that the market risk premium is what? 8%. Ethiopia pays tax at an annual rate of what? 20%. Both Equatorial and Ethiopia pay tax in the same year as when profits are earned. Now, for you to determine your base case NPV, what will you do? You need a cost of capital. And the step to determine your cost of capital is what? What are the steps as highlighted in the last class? You identify what?
Identify the proxy company.
The proxy company. And the proxy company in this question is what?
Ethiopia.
Ethiopia. Now, the calculation of, we need to determine our market value, because for us to apply our formula, you discover that we need to determine the value of equity, the value of debt. So calculation of market value. Now, going to the question. Ethiopia, which operates in the same line of business, which is the proxy now, as that of the projects Equatoria is considering, Ethiopia is financed by 40 million shares. Now, what is the value of these 40 million shares in Naira? If one share, yes. If one share is 3 Naira, 20 Kobo, what is the value of 40 million shares?
128 million.
128 million. Take notes.
Yeah.
Now, coming to debt, 30 million debt trading at 94 Naira per 100 Naira. You know, the nominal value of debt is 100, but it is trading at a discount of 94 Naira. What is the value of 34 million debt? Of 34 million.
31,960,000.
31,960,000.
Yeah.
Approximately, it will be what?
32 million.
That is 32. So calculation of market value. Let's see. Proxy company. The proxy company is Ethiopia. Proxy company is Ethiopia. So calculation of market value of equity. So we have it as what? 40 million shares. 40 million shares multiplied by what? 3 Naira, 20 Kobo. And this will give us what? 128 million. In terms of debt, calculation of debt value. Calculation of debt value. The value will be what? The value will be what? You have 34 million debt. That is 94 divided by what? 100 multiplied by what? 34. This will give us what? Approximately 32 million. Now, having identified it, what is the proxy beta? From the question, the proxy beta is what? You know, you need your proxy beta.
1.5.
And what is proxy beta? It is the equity beta what? Geared. The equity beta geared. Now, what will you do? The next step will be what? For you to ungear. Ungear the beta. And your formula to ungear the beta is what? The formula to ungear is what?
B.
Beta asset.
Asset beta
Is equal
equal
to
Equity over
beta equity
BEG
all over.
yes,
multiply by equity over
that is beta, not B. Beta. So we have it as what? Equity divided by what? Equity plus debt, brackets,
One
1
minus tax rate.
minus what? T,
Tax rate.
the tax rate. So now, from the question, we need to determine our asset beta. Determine our assets beta. And the asset beta, which is not known, we know our equity beta to be what? 1.5. The value of your equity is what?
128 million.
128. Divide by what? 128. The value of your debt is what?
32 million.
32 million. And your T is what? Tax rate? 0.2. 0.2 as given in the question. When you simplify this, what will be your result? 1.0,
1.25.
1.25. And how do we get that? You start with your board mass. 1 minus 0.2, you have 0.8. 0.8 multiplied by 32, the result plus 128. What you do, you say 128 divided by results, multiply by what? 1.5. You should have what? 1.25. Now, having determined this, what will be the next step? Calculate what? Your capital. Calculate capital asset pricing model. Capital asset pricing model. Calculate your capital asset pricing model, which is your CAPM. And your formula is what for CAPM? It is what? Is your cost of equity ungeared will be equal to what? RF what? Plus what? Plus beta. Plus beta. And we have it as what? Market return minus what? The risk-free. So your cost of equity ungeared will now be equal to what? Your risk-free is what? Let's go to the question. The risk-free is what? The risk-free.
2%.
2%. Government treasury bill is what? Is 2%. And the government treasury bills are risk-free securities. So it's 2%. And the market risk premium is what? Is 8%. Now, the difference between market return and risk-free is what? Is a premium. Is a premium. So now, you now have it. Your RF is what? Is 2 plus your beta. Your beta is what? 1.25. And your premium, RM minus RF is premium. And the premium value is already given to be what? 8. So your CAPM will now be what? Your cost of equity ungeared will be what? Cost of equity ungeared will be what?
12%. 12%.
12%. So this will be the value you will use to discount your new NPV. That is to derive your base case NPV. This value, 12%, will be your discount factor for base case NPV. For base case NPV. That is the essence of this step. Now, the next, let's just show the whole workings before we go back to prepare the base case NPV and see how we can arrive at our adjusted present value. The next, let's look at the issue cost. Let's look at issue cost. Work 8. Issue cost. That is, let's say present value of issue cost. Present value of issue cost. Now, what is our formula to determine issue cost? Issue cost. What is the formula?
Gross amount equal to net amount divided by 1 minus issue cost.
Okay. So we have it as net amount divided by what? 1 minus what? That issue cost rates. Yes. So for instance, you can still have it multiplied by issue cost rates. Yes. So now, based on this question, what is our issue cost or the net amount? How much do we need? How much do we need from the question? Sir?
42.97. That's
Okay.
the 38 plus working capital. At
Yes.
year zero.
Yes, at year zero. At year zero. At year zero, you need what? You need how much? Your investment value is what? 38 million. And also you need your working capital of what?
Of 4.97.
Of 4.97. So that will be the whole value required at what? At year zero. That will be the net amount required. That will be the net amount required. So based on this value now, if that will be the net amount required, what will be the gross amount? What will be the gross amount? So now, for issue costs, net amount is equal to what? The initial value of what? 38 plus what? The working capital of what? 4.97. And this will give us what? 42.97. So this will be your net amount. So your issue cost rate will be what? From the question, let's go and see. What is the issue cost rate? The issue cost rate. Issue costs related to raising the finance are what? 2% of the gross finance what? Required. You can see 2% of the gross finance required. So once you determine this, you can now substitute into your formula. Your net amount is what? Your net amount is 4297. Your issue cost rate is what? 2%. That is 0.02. 0.02. Still multiply by what? 2%. Now, when you simplify this, what will be your issue cost? Let's do it.
43.85.
The
43.85.
43.85. So this will be your gross value. So your issue cost will now be what? Issue cost will now be equal to your gross value minus the net value. And that will give you what?
0.88.
0.88. So you can get this 0.88 directly, even from this point. When you multiply that result you have here, when you multiply this result by what? 0.02. I think you should be able to get that. When you multiply that result by 0.02, let's see, 43.85 multiplied by 0. Yes, approximately. Yes. So please take note. In most, even in my class, in the last class, I showed it that way, but I quickly removed that this value here. I remove it so that I'll be able to point out some things. But you can also write your formula like this and work directly to get the issue cost. So that is also fine. So your issue cost is what? 0.88 million. Let's take note of this. Now, the question is, do you need the issue cost? What do you need? You need the present value of the issue cost. The PV of issue cost at year 0 is what? PV of issue cost at year 0. We give you what? If you revised the class from the table I showed, let me see if I can get that table. Adjusted present value. If I can get my last class. If you check your notes, you see the table on adjusted present value on the issue cost. You discover that at year 0, your discount factor will always be what?
1.
Will always be 1. So 0.88 million multiplied by 1 will give you what? The PV will be what?
0.88.
0.88 million. So this will be your PV of what? Issue cost. The PV of issue cost. Class, are we following?
Yes, sir.
Is the male that are following? Hope the females. This thing
Yes,
is,
sir.
Let me hear your voice so that I'll have peace. So now, some people are still very much busy. This Saturday morning is when people do house chores. But now we're having class. You'll not be angry. At least we'll finish by at least 10 if we are very fast.
We are following small. We'll go back to the video. That is sinking very well.
Okay. All right. So now let's look at the issue of subsidy. Subsidy. I discovered I didn't talk about this subsidy in my last class. Subsidy. Subsidy is reduction, having some reduction from what the normal value is. If you're supposed to get something for 20 naira and you're getting it for 15 naira, it means the price is being subsidized. So when it comes to subsidy, in subsidy also, we need to get the present value of subsidy. Now, going to this question, what are the issues of subsidy in this question? issue related to subsidy. That's working capital and depreciation have not been taken into account in the net present value calculation above. Since depreciation is not a cash flow and all working capital is returned at the end of the project, it is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from subsidized loan scheme. 60% will be obtained from subsidized loan scheme. Now, 50%, 60% of what? Of the amount required. 60% of what? Of the amount required will be obtained from subsidized loan scheme. Now, let me ask, Madam Odun, are you in this class? Or you just joined?
Good morning, sir. I just joined. My network has not been good.
Okay. Madam Pride, are you in this class?
Yes, sir.
All right. So now, the capital we need for this project is how much? 42.97. 42.97 million. The question is now telling us that 60% will be obtained through subsidized loan. So 60% of 42.97 is what?
25.78.
So we have it. Present value of subsidized or present value of subsidy.
Hello, Mr. Tokwe.
Yes, sir.
I realized that from our previous examples on issue
Yes.
cost that we enjoy tax savings on this issue cost, which also put in consideration then. But in this one, there's nothing like that in determining the present value of this issue cost.
Okay, tax savings on issue costs.
Yes. When we are discussing the present value of the issue cost.
Okay, the tax savings is in relation to interest. I don't know if you can check the workings again for the previous examples. The tax saving is on interest. Can you confirm that, sir? Tax saving. The tax saving.
Yeah. This one, when we are determining the present value of the issue cost at year 0, which is 1%.
Yeah.
Then at year 1, we now do tax savings of that issue cost. Now discount what we now have to arrive at the present value.
At the present value. Okay, I'll look at that.
Okay.
I'll check that before we conclude. So, present value of subsidy. Subsidy. Now, 60% of our actual of the capital required is what? The subsidized loan. Subsidized loan. The capital required, we have 42.97 multiplied by 60% of these will be obtained through subsidy. And 60% of these will be what?
25.78.
That is 25.78. 25.78 million. Now, on subsidy, there will also be tax savings on subsidy. Now, how do you determine tax savings on subsidy? Tax savings on subsidy. You will look at the normal borrowing rate minus what? The subsidy rate. In this question, the normal borrowing rate is what?
2%.
on subsidy. Okay, let's go to the question and see tax savings on subsidy. The normal borrowing rate. The normal borrowing rates. Let's see that. Now, look at note 5. That interest is based on Equatorial's normal borrowing rate of 150 basis points over the 10-year government yield. What is the 10-year government yield? 150 basis points over the 10-year government yield. The 10-year government yield, look at this point. Look at this point. Let's start. It is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government, which lends money at a rate of 100 basis points below 10-year government yield rate of 2.5. The government yield rate is what? 2.5. 2.5. Now, 0.5 is telling you that what? The normal borrowing rate of 150 basis points over. So it means 150 basis points above the government yield is what? Government yield is what? 2.5. So 150 basis points above this will give you what?
4%.
4%. 4%. That 4% is the normal borrowing rate. That interest rate is based, it is not direct, it's very dicey. Interest rate is based on Equatorial's normal borrowing rate of 150 basis points over the 10-year government yield. Over the 10-year government yield. The 10-year government yield rate is what? 2.5. Now, 150 basis points, we explain, will be what?
1.5.
1.5.
So 1.5 plus 2.5 will give you the normal borrowing rate. 1.5 plus 2.5 will give you the normal borrowing rate. We give you the normal borrowing rate. I don't know if this English is clear.
Yes, sir.
Yes, it is. They will come up in this way. So the tax savings on subsidy will be your borrowing rates. Your borrowing rates minus what? Your subsidy rates. Subsidy rates. And the normal borrowing rate is what? 4% minus what? Minus 1.5%. And this will give you what? 2.5%.
I can't hear you.
I can't hear anything. No.
Hello. What's up?
I think he's next. Well, because I can't even see him again. He has gone.
Network.
Hello, sorry. I have to quickly attend to someone in the office. Hello, can you hear me, please?
Yes, sir.
Yes, sir.
All right, sorry about
So,
yes. So as I was saying that tax savings on subsidy, we have borrowing rates less subsidy rates. The normal borrowing rate is 4%. The subsidy rate is 1.5%. So for us to determine the value of our subsidy, we still have to go some steps by saying that what to get the value of our net subsidy, which will also involve tax, we're going to have it as, say, amounts. That is, what is the subsidized loan? The subsidized loan amount. The subsidized loan amount multiplied by what? The subsidized loan amount in relation to the tax savings. In relation to the tax savings. To the tax savings multiplied by what? This value net of tax, 1 minus tax rate. 1 minus tax rate. So there is another formula we can show. That is, let me just show that also. Subsidized loan. Subsidized loan, net of tax, 1 minus T, multiplied by, open bracket, the normal rate, that is the normal borrowing rate, the normal rate, minus what? The subsidy rate. The subsidy rate multiplied by what? The discount factor. Multiplied by discount factor. We can also determine the PV of your subsidized loan using this concept. Let me delete it. So now, based on this I've put above, the amount of the subsidized loan is what? 25.78 million. Your tax savings on subsidy is what? Is 2.5%. Multiplied by what? Multiplied by this net of tax. Your tax is what? Your tax is 20%. 1 minus 0.20 will give you what? 0.8. When you simplify this, you're going to have what? The net subsidy value to be what? The net subsidy value will be what? 25.78 multiplied by, this should give us 0.516. 0.516. So this 0.516, what would be the present value of 0.516? What would be the present value of 0.516? What will be your discount factor to use on 0.516? Your annuity will come in. Your annuity. The annuity from year 1 to 4. The annuity from year 1 to 4 will be what? annuity from year 1 to 4 will give us what?
You're coming, sir.
So what is the discount rate you are using for the annuity?
2%. Government treasury bill. That's the risk free.
So the annuity from year 1 to 4
3.808. Using 2% as discount rate.
So on subsidy, let's see, 2.5. $0.025 on 0.025 minus 4 0.905 1 minus 0.905 So the discount factor to use, you said you use what, 2%?
Yes, sir.
Discount factor 2%. Okay. Let's go to the question. Working capital of 20% anticipated. That's the government yield. They said that issue cost relating to the finance at 2% of the gross finance. 2% of the gross finance. Okay. So when you use 2%, you say you have what, sir?
3.808.
Okay. 3.808.
Yes, sir.
3.808. Okay. Right. 3.808. I don't know if others are following. Depending
So where did you get the 2%?
So this is it. Issue costs relating to raising the finance are what? Are 2% of the gross finance required. 2% of the gross finance required. 2% of the gross finance required.
Okay, sir.
So 2% of the gross finance required. So when you do that, based on 4 years annuity, you're going to have what?
3.803.
So PV the PV of net subsidy, PV of net subsidy will be equal to what? 0.516. multiply by what? 3.8 what, sir?
3.808.
3.808. And when you multiply, this will give you what? 0.516 multiplied by 3.
1.945.
1.945. 1.945. So this is based on PV of subsidy. Now, talking about tax savings, PV of tax saved on interest. PV of tax saved on interest.
I got 1.964.
Yes, 1.965.
Yes, it's like for
Yeah.
965 approximately.
1.965, yeah.
1.965. All right. So the PV of tax saved on interest. PV of tax saved on interest. The question is, how much are we to borrow? Total borrowing is what? How much are we to borrow?
42 points. Total borrowing is 40.97.
97. Now, the normal borrowing aside subsidy is what?
4%.
Normal borrowing is 40%. 40% of 42.97. The subsidized loan will be what?
Wait, oh. The amount borrow, I think the amount borrow is 60%. Why the borrowing rate, normal borrowing rate is 4%, I think.
Yes, I put 40%. Normal borrowing is 40%. That is, we're trying to split. How much do we get through subsidy? We're able to obtain what? Subsidy. 60% as subsidy, and the other percentage is the normal borrowing. So subsidized loan, we obtain 60% of what? Of 42.97. So when you simplify this, when you multiply, this will give you what?
17.188.
188, approximately 19. This will give you what? This will give us what?
25.78.
25.78.
Okay. So give us 25.78 million. Now the question is, what are the interest elements on each of these? For normal borrowing, the interest will be what? The interest rate is what?
4%.
4%. So the interest element is 4%. So normal borrowing interest is equal to what? 4%. That is 17.19 multiplied by what? 4%. And this will give us what?
0.69.
0.69. And these will give us what? For subsidized loan. This will give us 25.78 multiplied by what? What is the interest of subsidized loan?
2.5.
Is it 2.5?
Yes.
It's 1.5. Can we confirm that, please?
Okay, subsidized rate, yeah, 1.5, 150 basis points.
1.5. 1.5. So when you multiply, you have what? This will give us what?
0.39.
0.39. So your total interest will give you what? Total interest?
1.08.
1.08. 1.08. So what will be your tax savings on interest? Tax savings on interest. This will give you what? Tax savings on interest. The tax savings is at tax is at 20%. So your tax savings on interest will be what?
0.222.
Okay, that is 1.075. That is 1.08 multiplied by what? 20%. So you said it will be what? 0. What?
0.22.
0.22. Now, what would be your present value of interest? Your present value of the tax savings on interest. What would be your present value of the tax savings on interest? The present value of the tax savings on interest. The value will be what?
$0.38. Since you are still maintaining the discount rate that we use for the net subsidy.
I got 0.83. 0.82.
Okay.
It's not 3.8. Yeah, 0.84.
0.84.
Okay. Now, please, help me determine if you use 12%. If you use 12% as your discounting factor, what will be the annuity value? What will be the discount factor when you use 12% for 4 years? That is using 12% as a discounting factor.
3.037.
3.037. Okay, that is not correct then. So now, our discount factor is what? The PV of interest will be what? PV of interest will now be equal to
0.84.
0.82 multiplied by, yes, what is our value? 3.808, right?
Yeah.
So this will give us what?
0.84.
0.84. 0.84. So let me come back to that subsidy issue, sir. So on subsidy or issue cost, that is issue cost, right?
Yes, sir.
Talking about the tax issue. So PV of issue cost at year 0, we have it as this. So the tax relief, the tax saved will now be what? The tax saved
That's
will be what?
0.8.
The tax saved. The 0.8 is what?
Is it 1 minus tax rate to get the tax saved?
The tax saved
Or 20.
the tax saved. That is 20% of what?
Of
20% of 0.88. We give you what? The cash flow.
0.176.
20% of 0.88. We give you what?
0.176.
Okay. 0.176. 0.176. So this 0.176, when you discount at year 1, what will be the value? The discount at year 1, we give you what? The discount. But what rates will you use to discount? What rate will you use to discount?
The risk-free rate. Or should we discount through using normal borrowing rate? Because I also asked the question before, like there's one textbook that I read that said that you can also discount using the borrowing rate stated as you notice in the solution.
Yes, yes. That is why they always tell you any assumption you make, you should put it down as a note. So any assumption you make while solving, you add it as your additional workings. So it's an open-ended question. So the current yield on the government treasury bill is 2%. It's estimated that the market risk premium is 8%. Prepare pays tax at an annual rate of 20%. Annual rate of 20%. So coming to issue costs. Now, issue cost relates to 40% will be funded. So for the issue costs, the discount factor will discount at the risk-free rate, and the risk-free rate is what?
3%.
So we'll state this as part of our assumption. Anything you use as assumption, you state. For example, you can state that it is assumed that debt issue costs are not tax deductible. You can state that subsidy and interest are calculated on the net finance required. All these assumptions will have to come up. So when you discount this value at 2%, when you discount this value at 2%, what will be your PV of tax savings? When you discount at 2%, the PV of tax savings will be what?
So the discount is this going to be in year 1?
Yes, just year 1.
Okay, the year 1 rate is 0.980.
Multiply by 0.176.
Okay. That's 0.172.
But
172.
0.172. 0.172. Now, this issue cost, we must note that
It's an outflow.
is an outflow. Now, tax savings, is it an inflow?
Yes, an
Yeah.
inflow.
Yes.
Yes.
It means that this issue tax savings will reduce what? Will reduce this issue cost here. The tax savings will reduce this issue cost. That is 0.88 M will be reduced by what? 0.172. And that value will be what? The value will be what?
0.708.
You now have 0.708 as negative. That is minus 0.88 plus what? 0.172. You now have it at 0.708. 0.708. So all these are workings. All these are workings. So for you to calculate your base case NPV, what will you do? For you to calculate your base case NPV, what
Simple.
are you going to do?
I'll just have to determine our cash flow.
Yes. So these are just workings. Let's quickly see how we calculate our base case NPV. Let's see how we calculate the base case NPV in very fast manner. Base case NPV. So calculating base case NPV, come up with a table, because the base case NPV is redrafting what? Is redrafting your NPV using what? The new costs of equity you have. the ungeared cost of equity. So, and what is the ungeared cost of equity that we derive using our CAPM? What is that percentage? The percentage is what?
12%.
12%. So 1, 2, 3, and 4. So now we have our cash flows based on our workings. Your sales is what? Your sales revenue is what?
In year one, we have 24.87.
24.87. In year two, you have what?
42.69.
42.69. In year three,
61.81.
and in year four,
36.92.
So the next is what? Direct project cost. Direct project cost. And in year one, is a negative value,
14.37.
37. And in year two, to be what?
23.75.
And in year three,
33.12.
33.12. And in year four,
19.05.
19.05. What next? We can come up with our profits. 24.87 minus 14.37 will give you what? Should be 10.5. 42.69 minus 23.75. 51.81 minus 33.12. And for this, 36.92 minus 19.05, you have 17.7. Haven't determined your profits. The next thing is what? Taxation. Taxation. Taxation at what? What is the percentage? 20%.
20%.
So 20% of 10.5 will give you what? Will give you what?
2.1.
20% of 18.94 will give you what?
$3.79.
20% of 28.69 will give us what? Now, having determined this, what next? What next?
For tax savings.
Tax savings. Tax savings. And the tax savings we move in accordance with the tax. So tax saved. Tax saved on what? On capital allowance. The value in year one is what?
1.
Year two, 0.4, 0.3, and what? 0.1. What next?
For capital,
Your scrap value.
scrap value, yeah.
Scrap value as at the end will give you what?
4 million.
It's 4 million. At this point, what else can you consider? Your
Initial outlay.
Initial outlay. Mr. Patrick, when did you move to professional?
I wrote this paper last night. I wrote 5. I mean, only this one. That's
Yeah, because you know, it shows you've solved these things before.
I don't know
So
about this SFM.
so your initial outlay is what? 38, right? We can also consider our working capital. The working capital as at year 0 is what? $4.97. Year 1 is what?
3.57.
And in year 2,
3.82.
3.82. And in year 3,
Positive for 4.98.
98. And in year 4, we have it as 7.38. With these, we can get our net cash flow. We can get our net cash flow. Net cash flow for year 0, it will be what? That's 4.97. We give you what? The capital we have been talking about of 42.97 negative. Now, in year 1, it will be what? In year 1, it will be what? 10.5 minus what? 2.1 plus 1.6 minus 3.57. This will give us what?
6.43.
6.43. And for year 2, to be 18.94 minus 3.76. Let me rule a line here. Plus 0.4 minus 3.82. And this will give you what?
7.73.
And this will give us 28.23, and this will be what? 25.78. With this, you cannot get your present value. Your present value is what? Or your discount factor is what? You'll be discounting using what percentage?
12%.
12%. Discount factor at 12%. In year 0, your PV, your discount factor will be 1.00. And in year 2, year 1 rather, it will be what? 12% in year 1 will give you what? 0.893. And 12% in year 2 will give you what? 0.797. And in year 3, 12% should give you 0.712. And in year 4, we have it at 0.636. So with this, you can determine your present value. Your present value will be what? 1 multiplied by 4297. You have negative what? 4297. For this, we have 0.893 multiplied by 6.43. You have what?
5.74.
5.74. 0.797 multiplied by 11.73. You have what?
$9.35.
9.35 and 0.712 multiplied by 28.23. You have what?
Two point zero 20.09 or 20.1.
20.10. Then for this, 0.636 multiplied by 25.78. You have what?
16.30.
16.4.
So your net present value will now be what? Net present value will now be equal to
8.62.
8.62. So that is it. So this is your base case NPV. Your base case NPV. Your base case NPV. So now, to calculate your adjusted present value, APV, what are you going to do? That is the A now. Is now we want to talk about 1A. Talk about 1A or just one. That is calculation of adjusted present value. That is APV. APV is equal to what? Your base case NPV plus or minus what? Plus or minus the financing plus or minus PV of what? Of finance effects. Finance effect cash flows. So we now have it as what? Let's come up with our table and see. This is just a very simple one. It's not complex. Is that my activity?
It's real.
So base case NPV, what do you have? 8.6.
8.62.
So now your PV of issue cost is what? PV of issue cost. That negative value. You said
0.708.
Zero point what?
0.08.
is what? PV of subsidy, what do we have?
1.9.
1.965.
Sorry.
65.
1.965. Then PV of interest is what?
0.84.
PV of interest. .84.
0.84.
0.84. 0.84. So with this now, what will be your adjusted present value? Adjusted present value will be what?
10.72.
10.72. So this small thing is what has been making us to move around since morning. So that calculates the adjusted present value. Calculates the adjusted present value for the project, correcting any errors made in the net present value estimates above, and conclude whether the project should be accepted or not. So what is your recommendation?
The project should be accepted.
Yes. So the
Because the
project
calculation.
The project is what? Financially viable, considering what? Positive what? APV of what? 10.72 million. 10.72 million. The B part is saying that what? Comment on the corrections made to the original net present value estimate and explain the APV approach taken in part A, including any assumption made. Now, what corrections have you made? What are those things you've made corrections on? You mentioned them. One, we can look at the issue of what? Inflation. That NPV, the NPV calculated ignored what? Inflation on the relevant cash flows. So, however, sales revenue and direct project costs have been inflated at the appropriate what? Inflation rate. At the appropriate inflation rate. Which other elements can we look at? Depreciation and working capital. It is correct that depreciation should be ignored in the calculation of NPV because it is not what? A cash item. But however, when you look at working capital cannot be ignored because it is not same amount spent on working capital that will be recovered. That will be recovered due to time value of money, because the value of working capital today will be different from the value in the next year. So working capital have been calculated and included now in the what? In the adjusted present value. So you can also look at the issue of interest. The interest, that is the NPV estimate included interest expense. included what? Interest expense. From what we have, it included what? Interest expense. You can see interest expense, but it has been what? Excluded in our calculation, based on our calculation of what? Adjusted present value. So all these values, these disparities that you observe, you identify them. You identify them. So now, the APV approach that you've used, the question is saying that what? Let's go back again to see that. Comment on the correction made to the net present value estimate and explain the APV approach. The APV approach. The APV approach. Can somebody explain the APV approach? You want to test your understanding. Do you, beyond calculation, what do you understand by APV approach? Yes. What do you understand by APV approach? Because when you see this, you're expected to write. The APV approach separates cash flow from operation, from cash flow from financing, and appraised each independently. So the relevant cash flow from operation is expected to be discounted using what? Your cost of equity ungeared, so that you'll be able to arrive at what? Base case MPV. Base case MPV. So you just need to explain what the APV approach is. So what are the assumptions you've made? The assumptions you've made. The assumption one, you can say cash flow is assumed. It is assumed that all cash flow estimates are realistic because you've adjusted them for what? For inflation. What of the discount rate? The discount rate. The discount rates have also been agreed with based on what? The 150 basis points stated in the question. So all the issues that have been itemized in the question, the way you've used them, you state them as assumption. Also, in the case of inflation, is also an assumption. All relevant cash flows were inflated at the appropriate inflation rate. And it is assumed that inflation rate will not change for the foreseeable future. So you've used the rate given to you in the question, assuming that in year 3, the inflation will remain same. In year 4, inflation will remain same. So all these variables you've used in computation, you come up with a write-up about them and not just leave them to go like that. So that is what you're expected to do as far as this question is concerned. I don't know who is having the ICANN Pathfinder. There is this question I'm looking for. Let me see if I will get it. If you have the ICANN Pathfinder, there's a question. Alankantara Limited is an unlisted company based in Akure. So it's similar to this question that we've solved. I'll look for it and forward it to the platform so that you can practice with it. You can practice with it. So, any question, class? This is SFM.